Greetings from Dr. Jeff Hong again. Welcome back to the continuing lecture in business methods. And today's topic is the overhead and markup. Now, let's take a look at the today's slide. Let's think about price, right? So in our last class, basically was ratio analysis, but before that, we talked about income statement and balance sheet, and the in income statement, we took price as given. Of course, price theoretically is determined by the demand and supply. So unless you are a monopoly, right, especially in a very competitive market situation, and if you are just a relatively average-sized company, right, with average product, the price is pretty much given because you don't have any control over the market price. Of course, the price would have to be greater than the cost. That goes without saying. But let's see if you are if you are in control and if you're able to decide your own price up to some extent. Let's take a look at the determinants of the price, or the components, right, of price. And but by any sensibility and by any common sense, we can tell that the price would have to be greater than the cost. Okay, so we can write a price as cost plus markup. Now, you might think, oh, if we break down the price, wouldn't it be a cost plus profit margin? Yeah, generally they call it profit margin, but it is not the profit margin exactly. Why? Remember, we used an example of Dell computer. We assumed the company is selling the computer for $500, and its production cost is $300, right? If it is $300, and let's say that's per unit production cost, including both CGS, the direct cost, and indirect cost, right? But let's say to make it easier, to make it simple, because the assumption we used in the last topic was that the per unit production cost is average variable cost, right? So which is direct cost only, right? Average variable cost is total variable cost divided by quantity, right, produced. So assume that the $300 is basically the production cost per unit, or the direct cost, right, or CGS per unit, total average variable cost, in other words. And then $200, you might easily think that must be then is net profit margin. No, that's called markup. Why? Because actually, if this is, think about it, if this is the direct cost, something has to give. the indirect cost must come out of something. What covers the indirect cost? Well, so markup, the indirect cost should come from the markup. But what is the indirect cost? You remember indirect cost was called OPEX, operating expenses, right? If you remember the breakdown of the income statement, right? The analysis of the income statement, the indirect cost is called OPEX or operating expenses, right? Also, AKA total fixed cost, right? Which is a microeconomics terminology. Now, but then overhead, so markup breaks down into overhead and profit. Okay, then what is overhead? Overhead includes OPEX, so that's the indirect cost, right? Remember, this is direct cost. This is the indirect cost. Okay, and then that means overhead breaks down into operating expenses and interest payment, interest expense, and taxes. Okay, so in other words, overhead uh, is the envelope term that basically envelopes these three uh, elements, OPEX, interest, and taxes. Okay, so what that means is the uh, markup is basically the $200 portion, right? That should uh, be the portion where um, the operating expenses and interest and taxes are all covered from, and still, after that, should still the profit must be derived from that markup. In other words, if you then think about it, isn't this exactly the structure of the income statement, right? Isn't that right? Look, this is only if you think about it, this is a scaled down version of the income statement, right? Isn't that right? It's like a miniaturized version of the income statement. It's scaled down to one unit, one single unit. This is the income statement of one single unit, right? Remember? Because price is what? Price is the revenue for just single units sold. Isn't that right? Price is just, remember, revenue is what? Revenue is price times quantity sold. Isn't that right? Remember that? And I've been telling you, it's indisputable, right? That definition, the mathematical definition is always infallible. I mean, uninfallible. Uh, there can be no mistake, right? You cannot fail, right? It's uninfallible, and it cannot be misleading, right? Um, there's no fuzzy, fluffy, verbiage there. It's quite straightforward and just, down to the nits and grits, right? Down to the bolts and nuts, right? So that's why I've been telling you that the mathematical definition is always the best one because it's indisputable, right? So if you think about it, revenue is basically a price times quantity sold. So if you sold one unit only, right, then the revenue is exactly uh, price. And if you think about it, this is the income statement for just one unit sold, right? Make sense? So this C is, I called it, not, this is CGS for a single unit, right? If you have just one unit sold, then this is CGS per unit. Means This is also operating expense per unit, OPEX per unit, interest expense per unit, tax per unit. Make sense? Profit per unit. Okay, so we can think of price in this term, right? In this in terms of this structure, right? Of course, when you multiply it by quantity, then that's revenue, total revenue. Multiplied by quantity, that's total cost, right? TVC, which is per unit production cost times quantity, right? TFC, which is the OPEX times quantity, right? But anyway, so if you now understand this structure, right? Basically, then how price is cost plus overhead plus profit, right? Then profit is what? Price minus cost plus overhead, right? So then this markup, which is an overhead plus profit, right? We can consider the markup. We can consider markup as some percentage of markup would be some percentage of cost, right? Markup can be thought of as some percentage of cost because, for example, in Dell computer example, right? Let's say the price is $500, and we've been assuming $300 as the production cost per unit. But just for our this, let's assume that the production cost is $200 and markup is $300. Then we can express markup as some percentage of the production cost. In this example, it would look quite it's quite obvious. This markup is like 150% of the cost. Make sense? 300 is 150% of $200. So it's 150% of the per unit production cost. And then we can factor out the same common factor because now 200 is common factor. You factor it out, then it becomes times 1 plus 150%, right? Or if you switch this around and make it, $300 a year and $200 a year, there will be like 67%, right? So if we summarize it algebraically, summarize it, then it's going to be cost times 1 plus markup rate. This is, MC stands for, M stands for markup, right? But when it is, I've been telling you, lower cases, it's a convention. It's not just randomly done in finance and economics. Rates are generally expressed in lowercase, right? So markup rate, right? Lowercase m, markup rate. What is that C? C stands for cost. So that means markup rate based on cost. In this case, 150% is 150% of $200, the cost, right? The markup rate based on cost. Okay, makes sense. And then we can express cost as price over 1 plus markup rate based on cost, isn't it right? Because if this is all z equals x times y structure, remember, right? Z, if this is z, right? Z equals x times y structure. So if you want to know what x is, then z divided by y, right? And I've been telling you repeatedly, over and over, that the key to solving any equation, no matter how complex they may be, right? The key to solving any equation is identifying the z equals x times y structure, right? But of course, to identify that structure easily, I mean, you cannot, with a very complex structure equation, you cannot identify that structure easily. So what do you need to do? You will have to simplify, right? You'll have to bring it down to the simplest form. You'll have to simplify that complex equation to reduce it to its simplest form, right? Then you will be able to identify that z equals x times y structure. And once you have identified it, solving for x is simple, right? So if you want to know c, then you would do this. But then next question is, why would you do that? Why would you want to know that? I mean, don't you know your cost already? Of course, if you are the manufacturer, if you are the seller, you would know your cost, right? But if who wouldn't know the cost? Of course, not the other parties, right? The other parties would include the buyer, and who else would it be more interested? I mean, if you're the buyer, of course you would be interested in the cost, but uh, if you're the buyer, then even if you knew the cost, right? Is there anything you can do about it? I mean, why would you want to know as a buyer the cost, true cost? Of course, then you might have a case. I mean, you can argue, well, I know how much iPhone it costs to make an iPhone. I saw the video on YouTube, years ago. The most expensive component in iPhone was not more than like $40, right? All the other parts are very cheap, and they use, sweatshop labor in, low wage country. It used to be China. China is no longer, I don't think, is low wage country. But wherever the labor is cheap, maybe now Vietnam or some other countries where labor is cheaper, then they sweatshop, right? The labor, right? Using almost like paying like $2 a day, right? And they still do with some coffee beans, uh, so they say oh, Starbucks is only doing the fair trade. They buy coffee from through fair trade. Blah blah blah. I don't know if they are really doing that, but it's unless Starbucks is really a conscionable business. But look, there can be no conscience in business. Why? Because some people, some businesses, some if it is sole proprietorship, right? Sole proprietorship, it can. If you are a conscionable, very conscionable owner, you may do that. You may practice, a fair trade and conscionable, uh, run a conscionable business. But look, all corporations are owned by thousands of anonymous uh, uh, shareholders, right? And the shareholders are greedy. In other words, and I'm not talking about the minor shareholders, but minor shareholders who hold less than like 0.0000001% of that company. Some of them maybe uh, but look, if you are a conscionable shareholder, right? And if uh, the company is practicing, sweatshop labor, right? Or Amazon is known for sweatshopping, their employees, Amazon is, but if you are buying Amazon, stock, does that mean you care? the fact that knowing that it's a known fact, it's a public knowledge that Amazon is sweatshopping their workers, right? Uh, but the fact that you're buying Amazon stock simply, it's the proof, it's the evidence that you don't care, right? If you're buying, I mean, there are some, investors who are practicing that, conscionable um, ownership. So they only buy the stocks of the company that are uh, socially responsible, right? But look, even if individual shareholders are conscionable, right? But I've been telling you, individual shareholders are only minority shareholders, and they are not even 0.0001%, right? I mean, I used to be Apple shareholder, and at the time I had only 10 shares, and 10 shares mean what? Like 0.000000001%, right? There isn't much that minority shares, uh, and the majority shareholders are, what did I tell you? Institutional investors, most institutional. Understand? Mhm. Wall Street firms, right? Asset management companies, right? Um, the insurance companies that have, that can mobilize. I mean, that has huge capital. They can mobilize huge capital, and those big um, institutional investors, banks, and those guys uh, are not even not people. They are just institutions, right? Businesses, organizations, business organizations, and the shareholders of, like, Goldman Sachs, shareholders of BlackRock, Ray Dalio's, asset wealth management firm, Berkshire Hathaway, uh, whatever, JP Morgan, all these um, something's, asset management firms, named the something something fund, something something capital, something. These are just, inanimate legal entities also owned by shareholders. I mean, those who own shares of these, asset management firms, financial institutions are, again, they don't know whether these, asset management firms are investing only, behaving socially responsibly. You understand? And these asset management firms and institutional investors are inanimate entities. They have no, basically, uh, they have they just invest. Their goal is what? I've been telling you over and over. The goal of all the businesses is ultimately maximizing profit, right? And in other words, it's also called maximizing shareholder wealth, shareholder value, or shareholder wealth. Because why? Profit belongs to the shareholders eventually, and and profit is basically shareholder wealth, right? And uh, shareholders will walk away. They will sell their shares, they will sell their stocks and walk away, put that money into another uh, fund, right? Another managed funds, right? Wealth management firm, or right? Makes sense. They will then, what's going to happen to the share value of the company? It will plummet. It will take a nosedive, right? So the management of these wealth management firms, right? Uh, Jamie Dimon, or Ray Dalio, or Warren Buffett, or the management of these, institutions, right? Institutional investors, they will do whatever they can to keep their job, to keep their pay, to keep their, you know, to keep their position. So then what do they do? Then they don't have that latitude to, you know, care for socially responsible um, investing. You understand? Whatever maximizes the shareholder value, that's what they pursue, right? There's no socially responsible investing eventually, right? Ultimately, there's no socially responsible. And then um, uh, so think about it. As I said, the company knows what their cost is, but um, uh, as a buyer, you would like to know what is the true cost. And as I said, the whole thing transpired. I mean, I kind of digressed a little because of the labor sweatshopping, right? Sweatshopping of labor, right? And um, the companies will sweatshop no matter what, right? Why? The more they sweatshop, the lower uh, the cost, the labor. Labor is, in general, I mean, the reason that they are all outsourcing, right? Well, the reason Ford Motor Company, General Motors, Chrysler, Dell, Intel, or Apple, all these companies are offshoring, right? You know what that means, offshoring. They are they are not producing within the US. They are all doing it. All the production, manufacturing is done in the offshores, right? In the overseas, where the labor is cheap. Why? Because in the US, labor is expensive, right? So they will do, if, you know, the first chance they get, they will do sweatshopping, right? But anyway, um, so what would you do? You go to, what's the true manufacturing cost of Apple, iPhone? Uh, Even if you knew, what would you do? You go to the Apple store and you're going to start an argument with them? Huh? Are you going to say, I know it's the true production cost of Apple is, the iPhone is not more than $200, but you're selling it for $1,000. Huh? So you are basically, gouging, right? Price gouging. Are you gonna then, uh, you're gonna say that to the salespeople in the Apple store? I mean, what good does it do? I mean, if you are making that argument, they will say, "Well, I'm sorry, there's nothing we can do. If you don't like our price, then please don't. You don't have to buy from us." I mean, of course, no salesperson would turn away a customer, but if you are trying to debate that with them, they are not going to oblige you. They're not going to take part in that debate, right? And even if you win the debate, they're not going to sell it below $1,000, even if it is proven that the true cost is, $200, right? Uh, to have that debate, you will have to take it to the Apple headquarters, but they won't budge, right? So then the question is, why would you want to know the true cost? I mean, of course, at least I would know how much I'm being gouged, right? How much I'm being, um, uh, ripped off, right? If it gives you peace in mind, right? Or whether takes the peace of mind from your away from you, right? Um, but who else wants to know? Who else do you think wants to know? Don't you think IRS wants to know? IRS? Why? IRS wants to know if these companies are cheating or not on their tax report, on their tax filing, right? Don't you think? Why? Because look, when you do your taxes, then you can do it yourself using some tax softwares, or you can use a CPA, right? Certified public accountants, right? Of course, for personal taxes, you generally, uh, but if you pay about probably $150, probably $100, 150, $200, they will do it for you. And another thing is, those CPAs know where you can. They know the tricks to maximize your tax return. I mean, if you do it yourself, you don't know. You just go by the book, and you don't know those tricks to maximize your return. But they know. I mean, that's their trade secret, right? Um, but think about it. I mean, even individuals use CPAs. Businesses will have to use CPAs. Public uh, businesses, you might wonder, don't they have their own accountants? Don't those companies? Yes, they have their own accountants, but then uh, it's like self-reporting. If you use if you are if a company is using their own accountant and report taxes, then it's like self-reporting. And how much reliability, how much truth um, there is. How much do you think, how much truth is there, do you think? Huh? It's like, um, I mean, in a gentleman's agreement is really, really, as strong as its weakest member. Isn't that right? It's like, um, uh, a lot of times, in schools, they give you a non-unproctored exam. In other words, the professor just doesn't proctor the exam, just gives you the exam, distributes the exam, walk out of the classroom and leave it to your own honor, right? Uh, but it's easily broken, right? So then think about it. Businesses. Donald Trump is a very good example. You know, uh, he's still afraid to. He's not revealing his tax returns. He's not disclosing his tax returns. Why? And Mick Mulvaney said, a couple of days ago, or a week ago, uh, he's not, doing it because it might embarrass him. Look, and Mick Mulvaney, um, he's lackey, right? Donald Trump's Mick Mulvaney was EPA, the director of EPA. I don't know what he's doing now, but but think about it. Donald Trump put every. I mean, EPA is Environmental Protection Agency, and he put someone who has been working very hard to defeat uh, you know, all those regulations imposed by EPA. In other words, uh, the the lawyer who has been working for these companies that are major polluters, right? For CDC, Center for Disease Control, Donald Trump uh, slash the budget for CDC, anything. Why? To give big tax cut to the 1% wealthy, right? So, and the CDC budget has been slashed, dramatically, drastically. So what? The country has no masks, no PPE, no ventilators, no nothing like even protective gear for medical professionals. Why? Because there's no public health infrastructure in the richest country in the world. Why? Because there's no public budget, right, for anything that is public, right? Why? Because to do that, public infrastructure comes from the tax revenue, right? And then Donald Trump, for the last 3 years, gave big tax cuts to the top 1% wealthy, including himself. So all these budgets to the government agencies that do all these, that build public and maintain public infrastructure, has completely been wiped out. But that's the nature of, if you think about it. I'm an economist, but I'm not, and I'm a financial economist. I'm not in favor of this shamelessly greedy and unethically selfish rogue capitalism, right? I call it rogue capitalism because it's not a model capitalism, but rogue, like a thug, mobster capitalism. It's called by many names, casino capitalism. And the way Donald Trump is operating business is just like the way the organized crimes operate. So there's no conscience in business. You understand? There's no conscience in business. So they are tempted to cheat. I mean, there's a huge incentive to cheat, especially on taxes. So if you let the companies to self-report their taxes, right? It's like leaving the what's the um, there's an expression, leaving uh, leaving the cheese pantry to the mouse, or I mean, uh, leaving the fish market to the cat, or right. So that's why the businesses will have to use third-party auditor. Third-party auditors are the accounting firms, right, that do the auditing for the companies. An audit in this case means doing the tax report. What that means is the third-party uh, accounting firms would be uh, making they would audit the income statement, the financial statements of the company, and ensure that the company's tax report is correct, right? And then these third-party accounting firm files the tax report for the company to IRS, and then they sign at the bottom, right? And that that signature, that endorsement, that signature means we are uh, putting our neck on the line, right? The accounting firm, third party CPA accounting firm, is putting their neck on the line and guaranteeing that this company's tax report is true, right? True to the core, right? It's basically, then think about it. You might think auditing means, you may have heard this expression a lot, we're getting audited. What does that mean? Usually in the corporate context, right? Corporate environment, when they say we're being audited, what does that mean? Um, IRS is directly auditing them, isn't that right? Why would IRS audit them? Because they don't believe, right? IRS found, uh, uh, suspicious, ground, the reasons for suspicion, reasonable ground for suspicion about this company's tax reporting, right? So usually you might think, auditing means, being, audited by IRS. Yeah, that it also means that, but that's true. But then think about it. IRS doesn't audit every company. It doesn't have time and resources to do that. Think about it. There are like tens of thousands and hundreds of thousands of businesses, large and small, large corporations to small, one-man operation, right? A small sole proprietorship. There are like tens of thousands, hundreds of thousands of companies in the U.S. IRS cannot audit every company's tax report, right? So how do they do that? That's why the third party, accounting firms comes into play. So the third party accounting firm's role is kind of, in between. They are acting as a uh, like representative for IRS, right? On behalf of IRS, they are making sure that this company's tax report is true to the core, right? Since they are acting on behalf of IRS, then that's why they are putting their neck on the line, right? But then think about it. Then these third-party accounting firms are, although they are acting on behalf of IRS, right, to make sure that the company's tax report is, correct. But also think about it, if they are too strict, if they are acting really like IRS, will they get any business? Right? This is a common sense thing, logically, if they are acting truly as a true representative IRS, they won't get any business, right? Because the company that would be hiring them for auditing or tax reporting will be uh, their clients, isn't it right? So for them, it's tax consulting. I mean, these companies are doing both tax consulting and tax reporting and management consulting as well. Management consulting is basically what? How you can save on taxes. Isn't it right? That's management consulting, basically. It's tax consulting. So then this is what? This is really, they are at the crossroad of conflicts of interest. Isn't it right? Those accounting firms, you've heard their names. I hope, I believe, because if you're business majors, then there used to be Big Five, and I think there are still Big Fives, but the names like KPMG, right? Price Waterhouse Coopers, and Deloitte and Touche, and all these. I mean, in back in 1990s, there used to be big five, including Arthur Andersen, KPMG, and Ernst and Young, Deloitte and Touche, and there were like five. And in late 1990s, Arthur Andersen was broken up. Why? Because of the fraud, Enron fraud. And you guys are too young to remember Enron, but because most likely you were born um, in mid to late 1990s. I mean, if you were born in 80s, and you're clearly a non-traditional student. If you are in college, if you were born in the 80s and um, or in the 70s and you're in college, you are very, old student. But if you are like 18, 19, 20, 21, you were barely born in the late 1990s. Enron scandal broke out in 98, I believe, 98. What was that? Enron was an energy company, and but they were not they were retailers of energy. Not they were not, in other words, power, electricity. But they were not really producing energy. They were not, they didn't own any power plant or nothing like that. They were like a middleman. They were like retailers. And then they cooked the book, right, to make it look, profitable. And the vice president at the time, Dick Cheney, and also the president, George W. Bush, all were, big shareholders of Enron. And Enron was a hot shot in the stock market. So Enron stocks were, but then in reality, this company wasn't making any profit at all. But they just cooked the book. On TV, they ran this commercial where Enron employees were all smiling, bright smiling faces, all happy looking. They were all saying, I love working at Enron because we are building the future, blah blah. All these, verbiage that they, dangle in the front, right? And these, employees look all happy, middle class, middle America, all, um, family oriented, community oriented portrayal of the company. All, but what was that? That was just a cover. And behind, in the behind the scenes, what happened was they cooked the book, made it look profitable, right? And Arthur Andersen, the accounting firm that was number one in the industry at the time, was involved because Arthur Andersen was the auditor for Enron. And they actively engaged in cooking the book, right? A double, dual book accounting or double book accounting, whatever they call it. So they had one book for their own, and then they had another book when they reported tax to IRS. So think about it. So Enron was, broken up. Enron got, by the court order, and some people went to jail, of course. Arthur Andersen was broken up. And so Arthur Andersen was broken up into two companies, one in just like management consulting, and the other one in just accounting. And the sequel, I mean the divested company, right? The spin-off from the accounting spin-off from former Enron is now called Accenture. Accenture is still in, accounting business for firms, and the executives of Enron and executives of Arthur Andersen, they all got sentenced, jail sentence. They served, I believe, they went to jail, and then, but think about it. Because of this, they have incentives. All these businesses have very high incentive to cheat on taxes. So that's why IRS cannot uh, uh, rely on the tax report. Even the third-party auditor, as I said, third-party auditor, which is big accounting firms, they serve two masters in a way, right? One master is IRS. They have to uh, work on behalf of IRS. They have to audit these companies on behalf of IRS. But on the other hand, they serve the interest of these companies because they are clients. And if they are being really, really too strict in auditing, then they will lose their all clients. They'll lose their business. And so uh, uh, this is really the conflict of interest, and there is a very high, a motivation and incentive for these companies for moral hazard. Okay, makes sense. So even though, I mean, most of these big companies, big auditing firms, after Enron scandal, they would be very cautious, right? Not to violate IRS uh, regulations, but still, IRS want, would not count on 100% on these tax reportings, and if they have sufficient grounds for suspicion, then they will audit these companies directly. But normally, they don't have time and resources, manpower and resources to audit all of the businesses. You understand? But then they would have to have some metrics, some measure to, if they, some measure, some metrics to evaluate whether the company is really, these businesses are really reporting, their tax reports are true and correct. So then that's why the IRS has all the incentives to know what the true cost is, right? And then if they know the true cost, then they would know what would be the markup, what would be the EBIT, what would be the EBT, and they would have some approximate calculation of the true tax amount, right? So that's the reason why we want to know, why we want to solve this equation for C, the cost. Make sense? Alrighty, the time's up. So more on this in our next class. Okay. All right. I'll see you guys in the next class. End of video.